On your journey through life, you are the hero. There are times, however, when it is beneficial to have an advisor to guide you along your path. Welcome to the Smart Money Simplified podcast with Brent Mekosh, certified financial planner, certified investment management analyst, and co-founder of MP Advisors LLC. In this podcast, Brent discusses some of the most important and interesting topics of the day as they relate to finance, the economy, and beyond. Now, on to the show.
Hello and welcome to Smart Money Simplified with Brent Mekosh. Brent, what's going on?
What is going on? Well, it is Thanksgiving week. Means that by the time this is released, we'll be a couple weeks past that. But I got a short week, and I'm looking forward to spending some time with my family this weekend. How about yourself?
All right. Yeah. I'm doing fantastic. So what it sounds like to me is that by the time this is released, listener, if you still have leftover Thanksgiving food, it's probably time to throw it away.
Yeah, you didn't do your job. You did not do your
Yeah,
job.
you should have worked harder on that.
Yeah,
all right, Brent. Well, I know you've got a guest on the show today. Who'd you bring on?
I got Michael Creadon on. He's president of DeFi Devs. So think software that is, and I'm going to let him explain this better, that is in the blockchain space. Now, this is, kind of a little aside here. Full disclosure, we don't play in the crypto world. It's been obviously something that as we've watched these assets, Bitcoin go to 66,000, back to 15,000 or so, I get a lot of questions on it. And Raymond James's policies, generally Wild West type stuff, we're going to stand back and watch what occurs. Well, watching what occurs this year anyway has been a pretty good thing, but we've got a lot of pretty high profile news items that have hit recently, particularly around FTX. But I wanted to bring Mike on just to, first of all, at a real basic level, explain what all this stuff is. And then we're going to dive into the FTX stuff. But Mike, that was a short intro for you. What more would you like to say about yourself and your background before we get going here today?
Oh, things are good. Thank you so much for having me. Again, my name is Mike Creadon. I'm a Chicago guy. I spent most of my career running a proprietary trading firm in Chicago. I was a full member at the CME. We were very, very active in U.S. interest rates for a long time. But 10 years after Lehman Brothers and zero interest rates, I decided I gotta do something else. And so I got into technology and blockchain in a pretty big way. And now I'm the president of a company called DeFi Devs. And we're the lead sponsor of a new protocol called Accumulate, which we'll talk about if you'd like. But that's my background in 30 seconds or less.
So Michael, at a really basic level, let's pretend that no one listening has an understanding of what blockchain is. What is blockchain? Let's start with that.
The way I look at it, and it's funny, it goes back to my roots in my career of trading. And there's various applications of blockchain, obviously, but think about it in one sense as an audit trail. Okay, how important is an audit trail? And like for what Accumulate does and where we fit in the space, instead of having an audit trail on a 50 lot of corn, who bought it, who sold it, what time, the exchange says this thing happened, and people can trust that data. That's the whole point. For an audit trail on an exchange, you look at it and you know that tape is real. Even if you anonymize the data, you still look at it and say, okay, who bought those 10-year notes? Who sold that gold? Or, not even who was it, but what was the quantity? What was the timing? What was the month? What was the duration? What was the call strike? Whatever. In private market assets, like commercial real estate and private equity, the marks on assets are very opaque, partly by design, partly by the fact that the technology doesn't exist. And so a lot of what Invenium does, our parent company, but then Accumulate as well, is kind of streamline the data in a way that, first of all, it's just organized, it's in one place, and then you can go through and credential and that data, so you have sort of an audit trail of all the data in and around an asset. Let's say that asset is Wrigley Field in Chicago, which I'm driving by, or you've got a private equity holding worth $3 billion. If you have all the data in and around those assets, credentialed and anchored in an appropriate way, then you're onto something, right? Because now what that leads to eventually is secondary trading of those assets. So I know that's a lot there, but again, I just think of blockchain as an audit trail for information, and that can be very powerful.
Yeah, I've always viewed it, and tell me if I'm on the right page with this. I've viewed blockchain as essentially being a ledger. And you
Right.
mentioned the futures and futures and commodities markets. The reason they exist is because people believe that the CME is trustworthy. They know that those trades are conducted. The clearinghouse is behind them. The trade's going to be a good trade. And I think the blockchain, to me, when I get questions, is there a there with crypto and blockchain? I think really there is with blockchain, because think about any business that has a ledger. There has to be some way. Raymond James, for example, the brokerage firm that I'm with, people trust the fact that their assets are held at Raymond James, that they are safe. And think about any bank, or think of a title company if you're buying real estate. And what I think blockchain has the ability to do in the future, what it probably will do, is really massively disrupt that space. But it's got to be done on a protocol, like you're saying, that everyone trusts. Am I on the right track with that?
Yeah. And there's just a lot of, there's just a lot of differences to a decentralized network, right? As opposed to a company that's run by a board, and just it's different. With a decentralized network, you have node validators and stakers, and there's a community where there's incentives set up to get rid of bad actors and to guarantee the validity of good things. Now, and that's how it's supposed to work. And in many cases, that's how the blockchain technologies do work. It's a shame that, and it's an irony that there's been so much malfeasance in the space. But as JP Morgan put in a report just last week, they said you look at what's going on in cryptocurrencies right now, all the bad actors have been effectively centralized entities, not decentralized. So it's funny, like the true merit of blockchain has yet to really prove itself to a wider audience, but I'm utterly convinced that over time that'll happen.
Well, yeah,
as there's more adoption.
Yeah, my take on it is that if we'd sat down in 1996, 1997, I could say, Mike, this internet thing, this is the real deal. And I would have underestimated the impact and the degree of which it would have for sure changed my life, changed business in the ensuing 25 years or so. Now, most of those early players, had you gotten involved, it was Wild West. Late 90s were Wild West for technology companies and internet stocks, and most of them, the vast majority of them, went away. And the value of those entities went to zero. And I think that we are in kind of that shakeout phase right now. In if you're talking about blockchain, DeFi, that type of thing, and the currencies, these cryptocurrencies that are riding on top of them. Would you you think that's where we are in the cycle right now?
Yeah, and there's it's almost hard to put into words how much junk there is, and and I don't mean to sound negative towards the space, but because I'm not. But let me just give you an example. Like I had a little bit of exposure to Ethereum and I was active in cryptocurrencies after I got out of trading in some capacity. And then when the NFT craze started, I thought, I'm going to buy an NFT. I don't know what they are, but I'm going to go buy one. I've got some, I'm going to go buy a $300 NFT and just see what happens. Then I tried to send it to myself. And the transaction fees on the Ethereum network were going to be $1,800. I thought to myself, I mean, just think about it in today's terms, like not using blockchain. If you went on to Amazon and said, I'm going to buy this coat, it's $300. My wife's going to love it. But it's going to cost me $1,800 to send to me. I'm not buying the coat. Sorry, I'm just not doing it, right? And again, I think Ethereum is amazing. It really is. But one of the flaws of Ethereum is it's extremely expensive. At times, the transaction cost can be exorbitant to the point where you say, I cannot be a high volume user of the Ethereum network because the costs are prohibitive. And so, there's, and again, I want to underscore this because it's very important. There's lots of things, tons of merit to the Ethereum network. But in that regard, the fee thing can be a real problem. And so other chains, besides Accumulate, have sort of solved that with, but being in the space for 5 years, the one thing I've learned is this space is filled with brilliant minds. And I'm talking engineers from the best schools, mathematicians, and they're trying to solve problems. And like, if you want to get short blockchain as a general concept, it's like you said, it's like getting short the internet in 1995 or 1992. How'd that work out for you? You know what I mean? Yeah. Now, again, there will be in any disruptive, transformative technology, there are 99%, frauds and 1%, or 1/10 of 1% that'll emerge. But it's that 1/10 of 1% that you want to that will change the world. And these projects exist. They're out there. It's hard to tell which ones are real and which ones are not. But there's so much. There's so much money that's been allocated to this, and there's a lot of people that are still building, notwithstanding the recent events.
Yeah. So again, for our listeners that may not be too versed in this, so we got blockchain, let's call it the ledger or the authenticated ledger. Now, on top of this, we have cryptocurrencies. And I'm going to segue into the whole FTX thing after this. But how would you define a cryptocurrency? Because I've never viewed it as, I don't view it as money as much as I view it as software.
Well, think about it this way. I mean, and the analogy that is most useful to me, and I have young children. One of them is in the back seat, and he's asked me if I own an NFT, but because he's listening. But if you've ever been to a Chuck E. Cheese before, or any kind of amusement park or thing like like game store, you go in and then you want to play the games, and they don't take cash. You can't use cash. You got to buy a card. Spend $25 or $100. You put it on the card, and now you have the local currency, and you need that local currency to operate, get on rides, play games, and then the real geniuses will have incentives like, hey, you want a bunch of points, you get a prize. But you can't function without that local currency. And for Ethereum and other networks, you need the currency for an actual explicit reason. It's not for speculation. It's to pay what are called the gas fees to use the network. So
expand on this.
There's a decentralized right. Yeah, there's a decentralized network. You want to participate, you got to buy in. And as you pay for it, some of that network, those proceeds get burned, depending on the model, and some go back to the stakers that are out there proving this network is real. And oh, great, I get paid. I get paid to prove that this is real. And so that's what's going on. And that $1,800 I mentioned, the payment that gets reinvested, so to speak, back in the protocol by the people that are doing the work. It's a fabulous model. It really is. There's a lot to these models, but that's why you need a currency in order for blockchain protocols like Ethereum to exist.
Your Chuck E. Cheese analogy is that's a good one. I hadn't heard that one before. That's an excellent one.
Yeah.
Okay.
That's one that works.
Now, you mentioned also NFTs. So again, I definitely want to educate some people here. We're talking non-fungible tokens. And that's something that I never kind of got that, because you would take, say Jack Dorsey's first tweet on Twitter, they made an NFT out of that. So, and tell me if I'm wrong here. Basically what you're doing is you're assigning a discrete piece of code toward an image or something. Yeah. And there's only one of those lines of code. Am I right on that?
Yeah, I mean, I'm not, believe me, I'm not an expert in NFTs, and I'm not sure what I'm an expert in general, but definitely not on NFTs. But I mean, look, I think that there's certainly some merit there. I look at it as a combination. Personally, this is how I see it, as a combination of like artwork meets technology. And this analogy I haven't really thought through, and I'm sure it's filled with potholes or whatever. But in the old days, you had a credit card, and it was from Visa or MasterCard or American Express, and that was it, and that was it. But technology just moves so fast now, and you could get a picture of, Lionel Messi, you know what I mean? A picture of, some soccer star or Michael Jordan or whoever. And all of a sudden you've got that limited edition, piece of artwork or whatever you want to call it. And now you could sort of, get people to say, well, I actually want that. I want that Messi piece of artwork, and I'll borrow it from you, and I'll pay you for the rights to use it because I want to advertise with it. And there really is a lot of opportunity, and that's the way I see it. Is leveraging artwork to say, what if we use this artwork as some sort of platform to do commerce? And look, I will say that in general, I think the prices of NFTs were sky high. They've gotten hit. The industry's probably mostly on its knees, but I don't think it's disappeared. I really don't. And I think that this is probably like the .com era for NFTs right now. But people always laugh at the .com era, but the fact of the matter is that's when companies like Google and Amazon and that's what they were built, like right in the ashes of the .com era. Some of the greatest technologies on the planet today were started. And so, that's the thing. I mean, the headlines go to the negative stuff, especially in a bear market, but there's good things happening. I would imagine in NFT, but I know there's good things happening in the blockchain space.
Well, I think that it's like anything when you're in this major innovation stage, 99.9% of the stuff that you try is not going to work. I mean, even look at Thomas Edison. What did it take? 10,000 tries, right, and he got the light bulb right. And yeah, I definitely think that we're in that now. So we've got, all right. So I love your Chuck E. Cheese analogy. I know I said that, but so we've got these networks. Excuse me. You've got the tokens, if you will, that are giving you in essence a currency of permission to ride on these networks. Now let's talk about if you're owning these tokens, you're owning these, if you want to call them currencies. Couple options to do it. This will be my segue into FTX. You can hold your own private key, right, or you can sit it on an exchange. And let's talk about private keys first. And again, not being super versed in this, the way that I've always looked at it, the best when Bitcoin first took off, the first round when it went from nothing to say 18,000. So we're talking maybe 2017, 2018 back then. I remember reading a story from a guy in England that apparently had 100 coins or something like that were stuck on the hard drive of his computer, which then went into a landfill. And he was trying to get permission from the city in England so he could try to go dig this thing up. And they're like, no, it's gone. So you can hold these sequence of numbers, these assets, if you want to call them that, on a thumb drive on your computer, not exposed to a larger network. Would that be a correct way to describe your own, if you're having possession of your own private key? Am I on the right track with that?
I missed part of your explanation. I mean, but just to like, it's fundamental. It's sort of binary in a sense. Like, if you own some cryptocurrencies, you effectively have two options, and there's always probably some third option. But one option is to leave the tokens on the exchange where you bought them. And so I'm actually a Coinbase user. I like Coinbase. I've left tokens there before. I don't think they'll fail. They could. But when you make that decision to leave the tokens there, you run a series of risks. One is that they get hacked and the tokens get stolen from them, but they probably have insurance. Number two, what happened with FTX here is they took those tokens and then lent them out in this whole shadowy secondary lending market. And then it's musical chairs, the music stops, you don't get your tokens back. But again, people, whether they realize it or not, see, because if you think about where most of us are in society, you have money. Where do you leave your money? You leave it at a bank. Why? Sure. Because the banks are FDIC insured. So I don't put my money under the mattress because that's dangerous. My house could burn down. It could get stolen. So like it's a fundamental reversal of that philosophy. You trust the banks because they're federally regulated and they're insured, so you leave your money there. This is the opposite. I can't trust the entity on the other side because they could get hacked or they could do nefarious things with my money and my assets. So I need to take possession of those things myself. It's a very powerful concept. It's for many people, it's too much. They're like, I can't handle it. It's too daunting. I don't want some ledger wallet that I carry around that's got $1 million on it. It's just too scary. You know what I mean? But once you make, if you can make that mental jump or whatever the amount of money is you have, suddenly you're in possession of this thing and you have the password to it and no one else has it. And you have to make sure you safeguard that thing, put it in a lock, put it, and store the thing, and make sure you talk to your spouse or your attorney and say, something happens to me, this is where you can find the keys. Okay. It's pretty radical stuff. It really is.
Well, it is, because no one can freeze it. No one can go anywhere on the planet with it.
Right. Right. And you're right. And it's scary. And I give myself about a D- on the management of my own keys, but I do it, and I don't have a perfect system, but anyway, I got to step up my game, because look, at the end of the day, and this is just my own theory, where did Bitcoin emanate from? When did it start? I mean, look at the origins of it. When did the white paper get written? It got written immediately after Lehman Brothers, like within months, or maybe it was a year or something like that. And that lack of trust for what happened there, for the banks to sit on people's capital, get money from the Fed for next to nothing, and then take inordinate risks, so that bank, CEOs and their traders can get big bonuses and go to the Hamptons. And then when they lose that money, which they did, and which inevitably will happen, whether it's FTX, Lehman, whatever, then the banks say, hey, federal government, give us a bailout. And you know what, American taxpayer, you pay for it.
Right.
You're paying for that. And some people said, you know what, that doesn't work for me. That doesn't work for me. I cannot trust this system. It's flawed. It's against me. And I'm going to do something different. I'm going to take possession of my own assets, and I'm going to have Bitcoin in my own personal wallet, and nobody can take it from me.
Right.
They can't take it from me. I literally have that asset, and it's in my possession, and you don't have, the U.S. government, try to get it. Again, but you still have, you still have to operate in a system of paying taxes and all that stuff. But that's what these private keys are about, and that's why they're so important. And I mean, if I would say one thing, listen, if anybody has, if you have any exposure to cryptocurrencies, either manage the keys yourself, or you better really understand who your counterparty risk is. But most people just, the crypto exchanges have shown they can't handle the responsibility. That's why, and sorry to go on and on, that's why in my mind, it would be better if someday you could store your keys at Fidelity, you could store your keys at Goldman Sachs, you could store your keys at, or they could store your assets for you, because you'd like to think that, it almost comes full circle here, but you'd like to think that Morgan Stanley or JP Morgan are not going to do what FTX did. And they would, and it doesn't have to be a bank, by the way. It could be Google, it could be whoever, and some third party could say, we'll store it, we'll insure it, we'll take care of it. And then you still have that decision to make. Do I do it yourself, or you let somebody else do it?
Right. Well, I think you're kind of sort of predicting the future there, because if you look at all the big banks, they are developing what their platforms are going to look like. So let's talk about the big story, because this thing is to me absolutely fascinating. So we got FTX. So we got Sam Bankman-Fried, I think in 2014, graduates from MIT, whiz kid, whatever. Opens up Alameda Trading, I think in 2019, which essentially was, we could even call it, almost like a venture capital firm, investing in a lot of DeFi projects and doing, I guess, trading in the crypto space. And then he launches FTX in 2019, which would be the exchange. So this is, people that don't want to manage their own wallets, or don't want to manage their own private keys. They want to put their holdings in these different tokens on a centralized platform, which was FTX. This thing rockets. It's worth, 2 weeks ago, I think the platform was worth $32 billion. You had the likes of Mr. Wonderful, Kevin Leary, I guess, pitching for it. You had Tom Brady. You had a lot of celebrities involved. You have Sam Bankman-Fried was, I think, the number 2 political donor in the midterms behind George Soros. Yep. So this guy all of a sudden is everywhere, and literally within 2 weeks, it's all gone. And there's probably a million people that had their money parked on his exchange that are now don't have their money anymore. The reason I reached out to you on this is because you put a phenomenal analogy out on LinkedIn about the Lamborghinis. I'm going to turn that over to you, because people are saying to me, all right, what the heck is going on here? What happened with this thing? And I've told a version of your Lamborghini story. So I'm going to turn that over to you and share with us what exactly happened here, Michael.
Well, and it's good timing, because my son, who I said I wrote the open letter to, is in the back seat right now driving around with me. So I tried to explain what happened with FTX, like I was telling Pat. It was a very bright 5th grader. But if you think about it, this is the analogy I use. Imagine you have an expensive car like a Lamborghini. You can't, a storm's coming. You can't park it indoors because you're doing work on your garage, and so you don't have an indoor option. So you look around, and somebody says, "Hey, I can park your car. Joe's parking lot, or Sam's parking lot. Come here, give me your keys. I'll park it for you." And oh God, you're such a lifesaver. Here, please. I can't handle the inconvenience of it all. So you do it for me. You take my car. Here are the keys. I'll give you money. I'll come see every month, and just God, thank you for doing this, and I'll just get the car whenever I need it. Perfect. Well, great. Time goes by. It's winter. You don't need a Lamborghini in Chicago during winter, but then spring comes. You go back to Sam. You say, hey, Sam, I need to get my car. Where you at? Oh shit, man! I got a problem. What do you mean? What do you mean? Well, somebody came in. They want to borrow it, so I lent them the car, and then they went joyriding, and then they stole it, and they sold it, and blah blah. I don't have your car anymore, man. And it's like, well, dude, like you can't do that.
Yeah.
You can't take my car and give it to somebody else. And that's what happened here. I mean, it's clearly what happened. They had tokens, and they lent them out to other shops because they were getting a paid a yield. And like I said, it's musical chairs. So I give it to you. You give me an asset. I lend it to you for 4%. You give me the 4%. You take it, and somebody gives you 6%. You're thrilled. Now you give to a guy who gives you 8%. Now think about that chain: 10%, 12%, 14%. If anybody in that chain has a problem, we don't get our coins back.
Right.
And that's this merry-go-round of lending. As soon as there's a problem, the lights are out. And that, that's pretty much what happened in Lehman Brothers, where you have a bank swap line goes down. Now Lehman can't play Goldman, Gold can't play JP Morgan. The whole thing falls apart. Right. And so that's really, I mean, I'm simplifying it, but excessive lending, excessive greed, a complete lack of institutional control, that brought down FTX, right? And it really is a tragedy. People lost a lot of money. A lot of people lost their entire life savings. Which
is tragic, because again, there's real people behind those that lost their money. And I think what's amazed me as I've dug into this one a little bit more is, the technology is different, but it's the same thing, man. They basically took client money. They trading / research arm, whatever you want to call it, which Alameda was backed by FTT, which is their own token. And all of a sudden, you get a run on it. And in this case, the run's triggered by CZ, the guy that's the chairman of Binance, I guess, which is the largest of the exchanges, that said, you know what, we own a bunch of this FTT, which is the token that FTX has issued. We're not so sure about this anymore. And he tweets it out. And next thing you know, everybody that's got an asset sitting on FTX on the exchange is like, whoa, wait a second, I want my money back. And guess what? It wasn't there, but it's the same story. The technology is different, but it's the same story. You have people misusing assets that don't belong to them. And again, no governments. I guess the cleanup guy that came in here is a guy named John Ray, who did Enron. He did Fruit of the Loom. He's done a ton of high profile bankruptcies. And his submission, his first documents he submitted to the court, said he's never seen anything like this in terms of complete lack of the financials, of accountability, of any kind of audit trail. But as an aside, Michael Lewis, who wrote Liar's Poker, Big Short, that type of thing, apparently he probably had more foresight than almost anybody, because he's been interviewing these guys for apparently the last 6 months or so. And I cannot wait to read. I can't wait to read the book that comes out of this, man. It's going to be incredible.
It'll be the greatest book of his entire career, and they're all great. But it's a shame. I think there needs to be just a general rethink of what we talked about before, is how do people take the tokens, and there just needs to be more education on it, and better solutions. I mean, one thing, and again, it's weird. There's a term called regulatory arbitrage, where people try to game the system of global rules with whatever in finance or technology, and it's really kind of a shame, because if cryptocurrencies were embraced more in this country, in Washington, by both parties, then there would be more solutions here. Maybe Raymond James, would step in and say, we could solve that problem, and people would trust Raymond James. They say, oh, they already have my other assets. Of course, why wouldn't I? They're regulated by FINRA. They're regulated by the SEC. I mean, and if you had that buy-in and the right legal structure here, I have every confidence personally that our banking system could absolutely handle custody of digital assets. I would gladly I bank at Chase. I have no problem having Chase have my tokens. In fact, I wish they would do it, so I don't have to worry about safes and wills and lawyers and and run around and passwords. I'd be like, dude, 2%, 1%. I mean, because like anything else, those fees would come down over time. They'd be nominal. There'd be insurance behind it, and you could sleep at night. And that's what the world. And it is in a way, it's it's sort of an oxymoron, but it's not, because we got to get over it. I mean, some people will never, ever, ever give their keys to a third party, and I respect that.
Yep.
But other people will. But again, it's the broader thing is, you need these decentralized networks. Society's going to need these decentralized networks to perform the types of activities that Ethereum, Avalanche, Polygon, Cosmos, maybe Aptos, hopefully Accumulate, the project I'm involved with. And you're going to, because they perform a service that's valuable, of credentialing data, an audit trail for information, that they do things, they solve problems. These blockchain networks solve problems that the current stack and technology can't solve.
Right.
And so that's why they're valuable. Wherever you put your keys, you know what I mean? Which is a separate and important question, but that's not the only reason these things exist, is for tokens to appreciate in value. That's not the only, or depreciate in this instance. But yeah, there's more to it.
Now, at what point do you think, looking at blockchain, at what point do you think we get mass adoption, through the economy of this technology?
I think probably people have been saying that for 10 years or maybe even longer, but I think that the next, 5 years even, I think the next 2 to 3 years, even the next year or two will be, fairly transformational. And I have to be sort of careful what I say about Invenium, was, a company I started with, and they offered me this opportunity here. All I can say in general is Invenium is the audience of just about every major financial institution in the world. And the conversations are very similar. Okay, whether they're fund administrators, whether they're banks, but these are this is the who's who of finance. And they're all saying the similar types of things, like, well, we have these assets, they're illiquid. We'd like to find secondary trading for our clients for all kinds of reasons. How do we get there? How do we get to liquidity for these illiquid assets? And the solution is better data. Okay, you need a better mousetrap for data. And
right.
And our philosophy is, well, who's going to trust the data? Let me give you an example. You have private equity funds, and I'm not trying to criticize private equity funds, but just the current model is Carlyle, TPG, whoever, all the, what's the big firm out in California? Anyway, all the big TPG firms, they mark their own books.
Right.
They say, oh yeah, this asset's worth, 3.6 billion. This is worth whatever. This is worth, okay, so like, who's going to transact in that? No offense, but like, who's going to, it's like saying, well, I think my house is worth $2 million. And the buyer says, oh, okay, then I'll just write you a check.
Right. Right. How you verify
you own it.
Yeah.
You own it. And so you've decided in your singular capacity as the owner of the asset that you know what it's worth because you own it. You know better than anybody. You don't think that there's a conflict of interest there, do you? Come on, like, stop. Of course there is. And so, well, then how do you get better data? Well, you need the data to be trusted. And how do you trust data? You trust it through an audit trail process with independent validators who have an incentive to keep the network alive, don't care about the asset. And they're out there saying, is this real? What's not? And they're all just fighting to keep that network. But anyway, the point is, to your question, I just see every day the biggest companies in the world trying to solve a similar type of problem. And so I don't know who the winners and losers are going to be. I don't know, where Invenium is going to fit in that, or Accumulate, or any of these other things. But I know that the problem that Invenium and Accumulate are trying to solve is a very similar problem to what the biggest financial institutions are looking at day in, day out, and stepping up the pace with. Because we're in active dialogue with these firms, we hear the feedback from them. Our commitment to blockchain is like 3 years ago they were kicking the tires. Now they're digging in. So that's where I come from a finance background, but I think that there will, and so I kind of see the world through that lens, and I see adoption in those areas. But look, there's going to be ample applications in healthcare, government, I mean, in every single industry you can think of, sports, television, entertainment, there's going to be applications. So, look, I think that whether people realize it or not, blockchain is already here to stay. Whether they look at the prices, FTX, they think it's going away. And people are saying, oh, it's going to disappear. I'm just wrong. I mean, the Ethereum network's not going to go away. It could be replaced by something better. Like any technology can be replaced. It's not going to go away. But I think you'll see more adoption, in the next, 2 to 3 years in a significant way. And I think the way you'll see it is companies will be making announcements about it. Big companies, and you already do. They'll be saying we have. Yeah, we are. I mean, just today, it wasn't really blockchain per se. Or maybe it was yesterday. JP Morgan just issued a patent for the JP Morgan wallet. I mean, exactly what we're talking about. Mm-hmm. They said, so they're already, I don't know what, there'd probably be just Bitcoin to start with, maybe Ethereum, but there you go. You can safeguard your keys there. And so, but like when you see JP Morgan, the grandfather bank of them all, the true too big to fail. Like they're the one bank because they're the closest to the Fed. They can never fail. We would have chaos in the streets if JP Morgan went out of business. And for them to adopt and take this technology and say, we're going to have our own wallet to safeguard Bitcoin, it's a demonstration of, and that's what people get. It's not binary where everything's decentralized or everything's centralized. It's sort of a hybrid model. And I think that's the solution you're going to see is the bigger institutions will start to embrace, cryptocurrencies, blockchain, Bitcoin, whatever, and it'll be a little bit of the old world meets a little bit of the new world.
Well, I also think you're going to see big adoption here by central banks. I mean, you're already seeing, and think about how you can exercise monetary policy if you have everyone on a digital currency. I think, in China, they're doing the digital yuan now with an end date where you got to spend the money by a certain date. It's basically disincentivizing savings and talk about power there. You want to juice the economy, put an end date on everybody's dollars. It's pretty crazy.
I mean, people are so threatened by the security and privacy aspects of central bank currencies, and I see more as a positive than a negative. But you think about it, in the old days, stock market goes down, people panic. Fed cuts interest rates and stocks rally, but that doesn't benefit all of society. It just benefits the people that have money. That's all that happens. You saw what happened during the pandemic. Government said, well, holy God, we got a real problem. Easing interest rates isn't going to be good enough. We need to send cash to people. We need to put cash out. Yep. So, I mean, think about it. With a central bank currency, fine. There's a crisis in the markets. People just, I mean, it already just happened with the pandemic, but now the government to just say, hey, we're gonna send money directly to clients. I mean, not clients, but citizens. Right. I know it's pretty, but look, there's a lot of different options. There's a lot of options here, but I think if you believe in a regulated economy, you shouldn't be threatened by a central bank currency. I mean, if you're a drug dealer and you don't want to report taxes, then you're gonna hate it. But if you're an established business that pays taxes and files reports with government agencies, what's not to like about it? That's how I look at it. I don't know.
Well, it's gonna be interesting to see. Utility. Yeah, I mean, it's gonna be interesting to see where this goes because I think that I agree with you in the sense that anyone that looks at what has occurred here, and this year's been, it's been challenging for every financial market, but it has been an absolute, dumpster fire in the crypto space. But what's going to come out of this? There is definitely something that's going to rise out of the wreckage of this, and I think it's going to be pretty powerful. It's going to change the way a lot of companies do business. And Michael, I really appreciate you taking this time and talking to me today. How do people reach you if they want to learn more?
Sure, I do write. I'm very active on LinkedIn. I've been writing on LinkedIn for almost 5 years, like every single day, and so send me a message. Just send me an invite or whatever. I may be connected to people already. There's a lot of connections, but LinkedIn is definitely the Accumulate Network website. Yeah, I'm pretty easy to find.
Awesome. Hey, Michael, again, thank you so much. I appreciate you taking this time to chat with us, and definitely an eye-opening conversation that I can't wait for people to listen to.
Thank you so much.
Michael and Brent, this has been fantastic. Michael, again, thank you so much for your time and all the information. I found it fascinating. Brent, of course, thank you for facilitating this podcast and bringing him to our audience. And speaking of you, the audience, thank you so much for tuning in and listening to the Smart Money Simplified podcast with Brent Mekosh. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Brent comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, as this does help others find the show. Again, thank you so much for listening today. For everyone at MP Advisors, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to this episode of Smart Money Simplified Podcast. Have any questions about topics covered during the show? Visit www.smartmoneysimplified.com or give us a call at 602-255-0555. Don't forget to click the follow button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and/or guests and does not necessarily represent the views or opinions of Raymond James Financial Services Incorporated. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional financial advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your individual situation. Securities are offered through Raymond James Financial Services Incorporated, member FINRA, and SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated, MP Advisors LLC, is not a broker/dealer and is independent of Raymond James Financial Services.